Welcome to another edition of By Design, where we believe businesses should be run by design and not left to chance. Today, we're here with my good friend and M&A expert, Shay Houser. Shay, how you doing?
Dude, I'm doing great. It's great to be here, Dale.
Yeah, well, great to have you. Thank you for taking some time to chat with us. Today, we're going to pull back the curtain on the M&A process. Seems to be a lot of confusion around the M&A process, and we just want to go behind the curtain with someone who knows the game. So start off, just tell us a little bit about what you've been up to these days.
Absolutely. Look, it's great to be here, first of all. I appreciate it. I think it's crazy. I'm sitting in my old office from Green Cloud Technologies. I think after we did Green Cloud and you guys came into this space, Marty had this office. So this is a little bit of a flashback here. It's kind of crazy. I remember this wall very well, and people walking on the outside of it, banging on that wall as I'm trying to get stuff done. So that's pretty funny. But, for the last couple of years, my partner and I, Scott Millwood, we've been running a small venture fund here in town called Founderville. We invest in Greenville-based B2B software companies. It's been an exciting time. We've invested in 8 companies really over the last 18 months. We've put $3.25 million to work. We got a couple other companies that we're in diligence right now. And really the goal over the long haul is continue to invest this fund, raise a second fund probably in another year, and then additionally recruit software companies to Greenville. Our goal is to recruit 80 software companies to Greenville over the next decade. That's a big charge, big mission. That's the type of goal we like to shoot for. So we're thinking really big, and we really want to build right here in our hometown.
Yeah, that's awesome. It's always better to dream big than dream too small.
Heck yeah, man.
Let's dream big, and heck, even if you only hit 75, that's a heck of an accomplishment.
Swing for the fences.
But that's part of the reason we wanted to bring you on. As by design, we love doing the do. We help businesses grow and get their foundation set. But we really wanted to get your thoughts on that. Like, what do you look for in businesses and that sort of thing? So let's start by maybe I always like to get the mistakes out of the way. So
sure.
As an M&A person, as an investor in company, what are some of the top mistakes you see companies making?
Yeah, sure. I mean, in going back in time a little bit, so just to give you a little bit of background on the M&A, I guess that I've done, I was really lucky. When I got out of Citadel in 91, I went to work for a company called Corporate Telemanagement Group, which was just beginning sort of their M&A process. And I was in product development, product marketing for a number of years, but then moved into corporate development and worked for the guy that was running the M&A process. So between 93 and probably 95, I worked with a gentleman as they bought 10 different companies. So I had no clue what I was doing, and I got to sit there and watch. And I watched all parts of the process from essentially outreach and beginning the negotiation, the dance, if you will, all the way through the process of getting something closed, and learned a lot. And then after that, as I started the different companies that I had built, probably I guess acquired 20 plus companies, and probably tried to acquire 50 and maybe got 20 done. I don't really know at this point how many it is and how many I've sold, but it's been quite a lot. I think a lot of different mistakes can get made. I think overall, though, if you look at just top down, what's the biggest one? It's not planning. It's simply not planning well in advance and waiting for somebody to show up at your doorstep, or not planning and then having somebody show up at your doorstep and drop a letter of intent in your lap. And although that might seem exciting, I can promise you're not going to get the best price if that happens, because unless you had the greatest 12 months in a row of history of your company, you're fundamentally at a disadvantage right there. You just haven't planned, you haven't taken cost out, you haven't done what you needed to. So I think that part of it more than anything else, I think founders are focused on their business, and they're not focused necessarily on planning to sell the company.
Yeah, that's a stat in the SEPA organization that around 50% of business owners have done no exit planning at all.
I believe that.
And almost 80% don't have any documented planning, which means they've probably thought about it for 5 minutes and then kind of let it go because they're in the business and not working on the business. You tell us a little bit about the M&A process at a high level, because I think there is some confusion around maybe M&A not being your friend or being your adversary and wanting to come in. So maybe talk a little bit about that.
Yeah, sure. I mean, I don't think of it as friendly or adversarial or anything else. I mean, ultimately, you have a buyer who finds great value in your business, right? I mean, they're looking at your business because they believe there's value there. What they're going to do with the value might be different, in terms of they may recognize value differently than you might as the business owner. But regardless, that's an exciting time. It's a great time. There's fundamentally see value in what you've created. The process typically is, if you forget what planning you've done or not, you're going to be reached out to by, whether it's an advisor or in many cases directly by a company, and they're going to express interest. And that interest could be soft interest, which is usually where it begins, and then that leads into ultimately a dance, if you will, this courting period. And the courting period, look, it could last 60 days. It could last, I've had it last 18 months in cases. So I don't think there's a set time frame. But eventually the courting process begins to turn into, hey, let's really date and let's look and see if there's something here. And that process typically, when it starts getting serious, could last maybe 60 to 90 days, in which the goal is at that point a letter of intent. A lot of cases, I like to joke, they're sort of non-binding letters of non-committal. But, at the same time, they can be binding. It really depends upon the situation. And from there, once that, that agreement, whatever it is, gets signed, you're going to have about 75 to 90 days ultimately before closing. A lot of moving parts behind the scenes, depending upon what type of transaction it is, whether it's a stock purchase, whether it's an asset purchase, whether there is financing required by the acquiring party, whether there's debt involved, how much equity, so many pieces of the puzzle. While the acquiring company is worrying about all that piece of it, how they're going to finance it, your company, right, the company being acquired, you're doing a lot of work. And it's an enormous amount of work and lift that's got to take place to prep the documents to ultimately get closed. So, I don't think there's a set time frame on these things. They, again, 18 to 24 months, but it can happen as quickly as 90 days. It just really depends upon the situation.
Yeah, the letter of intent is interesting. And in my experience, they're good and bad things, right? Mm-hmm. They're very exciting when someone gets them. Like you said, it means somebody wants what you built. But if you haven't done the planning and you don't have the confidence, the clarity, and the knowledge of kind of how values driven and how an M&A person puts the math together, we always say it's pretty simple math, right? Mm-hmm. It's a sales figure, or EBITDA times a multiplier is kind of where you're going to get to. But if you don't understand that process and how they do it, you get this LOI, you get all excited, then you get into due diligence, and that's when they start to kind of really nitpick everything about your business. And if you haven't done the steps prior to that, I think that's when the LOI goes from X, and it kind of goes down to Y. And you may be really excited about X, Y not so much.
The X is the starting point. The letter of intent is the starting point. That's not the finish point, and rarely is it the finish point in terms of the price or the terms. And I've used letters of intent that are as short as 2 pages, and I've sent letters of intent that are 9 pages, that are highly detailed, that spell out many, many deal points that in reality we could have skipped the letter of intent and gone straight to purchase agreement. So many sellers are used to the idea of a letter of intent. I found that difficult. However, you can negotiate so many of the terms in the letter of intent that it does make the purchase agreement itself a heck of a lot easier. To your point, though, if you haven't planned on this process, also if you don't have an advisor and you haven't worked with an advisor, if you get a 5 or 6 page letter of intent, it's going to overwhelm you, and you're not going to understand the language, and you're not going to fully grasp what each aspect of these things mean. You shouldn't, unless you've gone through it. Unless you've done M&A, you're an M&A lawyer, you're a transaction expert, you're not going to know this stuff. You need help with those types of things as you go through this. So it can be overwhelming at times. I think that's why the advisor and, of course, the planning and the process is so important.
Agreed. Let's get into that a little bit. So let's say you sign your LOI and you're really starting to get serious. I love the dating analogy. So we're really starting to get serious dating, and now it's time to look at bank accounts and stuff like that. Yeah. Maybe what are some of the top green flags? We'll start with green flags that you're looking for in that initial, when you start to dig in, and then I wanted to also talk about some of the top red flags.
Yeah, sure. From a buyer's perspective, what I want to see, the perfect world, are very consistent growth numbers across the board. I would love to see just up and to the right on everything except cost of goods and personnel, right? Yep. SG&A, it can be more flat. But I think it's a long cycle of growth is very important for me as a buyer. Look, some companies aren't going to have the growth that others, and of course that's going to impact the EBITDA multiple that ultimately gets paid. But I think consistent earnings, tax records that are pristine and clean, is I look at very basic due diligence items on the front end that are going to tell me a lot about the seller in them themselves. So I'll give you an example. I want to spot check 10 employee handbook signatures. So I want to see the entire employee handbook. I want to see signatures on everything, right? I'm going to do the same thing with customer contracts. I'm just going to want a list. Here's 10 of them, right? Give me those. That's more in due diligence, but those are things that don't seem like a big deal, but they tell me so much about the company ownership and about the company leadership that if I can ask for that information, it comes back to me like that and everything is signed, right there I know, okay, attention to detail, that is important. Tax records are the same thing. I mean, it's the last thing you want to get into is too far down that cycle. And then the buyer realized we got some tax issues because you talking about a deal killer. It gets to the point where it's like, life's too short, don't need it, moving on to the next one.
You're giving me some PTSD back to my OSHA audits back in my manufacturing days where they do the same thing. They pull 10 employee files, and if those 10 are pristine, they usually move on to something else. But if they find one mistake, they want to see 100 more. And now we got to get deep into it. So totally get that. What about some red flags?
I mean, the red flags, again, it would be the exact opposite of that, of course. It's taking too long to get information back, not being responsive, not fundamentally understanding what we're asking for. So if we're asking for records related to AR and AP, for example, or inventory turns, and they're just, the seller's having a hard time grasping what we want, or the information's coming back in just random formats, it doesn't look good, it's inconsistent, there are mistakes inside of the data that ultimately are going to get found. I mean, huge red flags, because again, it's like, this tells me everything about attention to detail of not just the owner, but more important, the leadership team. I care about the leadership team because in many cases, that's who's going to be working with me, not the owner. If there's one or two owners, I know they're going to bail out at some point. It's unlikely they're going to work with the company for a long period of time, and we can put them under contract for a period of time. But I think those types of mistakes are the ones that I'm going to look for, those red flags. It's going to cause pause, and it will impact the way I think about the value that's out there on the company.
Yeah, it's interesting you mentioned the leadership team. You know, I'm a big people person, and you win with people and and that sort of thing. What are some things you may look for as an M&A person with that leadership team? Is it retention contracts? Does the owner have retention bonuses in there? Do you guys look at that?
Absolutely. I mean, that stuff's critical. I mean, depending upon the size of the company and what it looks like in the leadership team, again, you're going to learn a lot about the owner and the way he thinks just based on retention plans that have been put in place, exit bonuses that might have been put in place, things like that. There's going to be a long process between meeting with the management team, getting to closing, and figuring out where each person is going to fit. There's a lot of issues related to cultures. I know you know. So it's a hard one to answer, but I'm going to look for spending time with the team, and then I've got to just make gut feelings gauge based on how they're going to interact with the management team that we have placed, depending upon whether it's a roll-up strategy or a 60-40 merger, if you will. You just don't know.
Yeah, by design, we're big in assessments, profiles, and skill sets. Do M&A folks use any sort of Working Genius, DISC, Myers-Briggs, any of there's a gazillion of them out there.
The M&A, I mean, I'll say this, the leadership team of the acquiring company in many cases will do that. They're going to look at that stuff as they figure out who's going to come into what place on the team. Because in many cases, I mean, again, you're looking at that leadership team, particularly the sort of the second level down that are highly likely to be with the company over the long haul. You're really looking at that team and where they're going to fit into the organization and ensure making sure there's a fit as best as possible.
Yeah, so to recap a little bit, green flags, consistent growth trumps spikes and valleys, valleys. People are very important. You want to make sure you have the right team that can carry on without you. Financials, obviously having your taxes and stuff pristine and audited and up to date. Is there anything else that kind of are immediate red flags or immediate green flags when you're deep diving into businesses that'll kind of give you that go?
I mean, I would not underestimate the power of, again, the detailed on having executed contracts on all the customers, having all the employee files in order, having quick access to all those types of records. It just shows some indication of how the leadership's thought about those things, whether they're sloppy or not. Sloppy is not good. If I see sloppy records, I'm not impressed, and it's going to cause an issue. It just will. Inevitably, it tells me there's something else out there that I'm going to have to deal with. So, that planning that in many cases an advisor is going to help a seller with early on, super important. Don't underestimate it. If you have an advisor that's working with you a year before you're thinking about selling the company, they're going to look at the contracts. They're going to see every single customer better have a contract. And if not, go get a signature. There's a real reason for that. That's not fake. That's not just busy work. That is crucial work that has to be done.
Yeah, we call that the de-risking phase, and we think it's one of the first things a company has to do.
Has to happen.
And it's just for that reason. And sometimes I think they're like, well, why are you getting on my case overall? It's just an employee contract, or it's just this or that. But that's exactly why,
Absolutely.
right? Anytime a potential buyer sees risk, which is what that is, it becomes a red flag. And again, we start talking about LOIs at Y and you end up at X.
Yeah.
That's a reason. That's a big reason why you're going to go from X down to Y.
That's why it drops and doesn't increase. That's right. Yeah. They rarely go up. They often go down.
So if you had to give a business owner one piece of advice, what would it be?
Plan. I mean, that is if there's any takeaway from this and me running my trap, it is that it is plan for the process, get somebody to help you, and make sure you work through everything that they tell you that needs to happen before you get to the point of you're going to solicit, letters of intent. You're going to solicit offers for your company.
Yeah, and I think where people struggle with that is they may not even be planning to exit or transition, but that phone rings one day.
I love that situation.
And it's
a buyer. That's my favorite. I would stalk company owners for a year, and they would have no idea that I was stalking them. I would find out everything I could about their company. I would go to trade shows. I would talk to their salespeople. I love talking to salespeople of a company that I want to acquire because I can find everything out.
That's interesting.
Oh my God, are you kidding me?
Yeah, tell me more about this.
Trade shows, 3 beers, sales reps. You talking about due diligence? That is due diligence. I mean, don't assume you're not being sought right now. Somebody's probably looking at you and you don't know it. But there's nothing better than just literally dropping a letter of intent or a non-binding letter of non-committal on a CEO's lap, because you talking about catching them on their heels. They're on their heels. And at that point, the emotion begins, and I've already got everybody the advantage. I've been planning. I've done research. I know stuff. I probably know revenues, even if they're private. I know sales information because I've talked to the sales reps. Maybe I've recruited one of the employees. There's just so many ways to do it on the front end that puts the buyer at the advantage and the seller at the disadvantage.
Yeah, that's so interesting. That's going to trade shows and finding the drinking sales reps.
Sales reps love to talk.
Especially when you get a few beers.
That's
there,
it.
Right?
That's it.
You spoke a little bit about leaders. Are there certain characteristics other than just minding your P's and Q's that you as an investor look for? Is there kind of a typical profile of a leader you want to invest in versus not invest in?
It depends. I would say, so this is my perspective. The leaders are important, but more so on the second level of the management team. And the reason I say that is, in my experience, once the company's acquired, a year out, many of the very senior team, the C-level people, are gone. They just are. So now that C-level leadership team should set the pace for the second level, the next layer down of management. But that management layer, I probably care as much about as I do the senior team, because the senior team may or may not be there over the long haul.
Yeah, we started talking about this as a dating example.
Yeah.
And the C-level team, it's kind of like, well, we didn't pick you and you didn't pick us, but now we're at the altar.
That's right.
So
That's right.
Yeah, I can see where that doesn't work. And in my experience, same thing, right? The C-level, they joined maybe a small startup. They've helped grow this business. They're really invested, and then somebody's just going to come in and buy. And we all know change is coming, and the way we used to do stuff may not be the way we do.
Absolutely.
So I do believe next gen leadership and knowing your people and having sort of a succession plan for that group, is that important? I think it is.
It's important. Ultimately, I'm going to price the deal based on economics, right? And then I'm going to weigh different risk factors inside of the economics based on what I'm seeing through due diligence. The leadership team is a part of that. So it is a lever, it is not the lever. It's an important part of it, but there's a lot of other aspects that are important. I've got to price that deal based on what I think I'm going to get out the other side after 12 months of integration, right? So yes, it is a part of it. It's not going to, I doubt a leadership team is going to sway my opinion about buying a company one way or the other, but it can definitely impact the value or what I'm willing to pay.
We think 80% of the value of a business isn't on the balance sheet.
No doubt. No doubt.
And part of that is that, right? It's the people, it's the process. We call them the 4 C's. And so as you just mentioned, you kind of value certain things more or less. Let's get into the 4 C's just a little bit as far as how do you value them? You know, is it high? Is it low? It's human capital, client capital,
sure,
social capital, and structural capital.
Right.
So, you know, human capital, I don't want to put words in your mouth, sounds like it's a pretty high priority as far as how it impacts value.
Well, I mean, I think, listen, I mean, if the company has not been doing really well, it's an indication of the leadership team in the human capital, right? I mean, so ultimately, I'm interested in companies that are going to add rapid growth or some new distribution channel to whatever I'm building at the time. So for me, in a lot of cases, it is going to be that human capital. It's going to be structural in that a distribution channel, a product or a service that is complementary to what I've got today. And then do I believe that this team right here is a team that can push this forward as we bring these things together? Can the cultures fit ultimately? Can we bring this thing together? And then can the teams combined, but particularly the team that I'm acquiring, can they push it forward along with my team?
I would think one of the biggest concerns from a buyer's perspective would be you spend a bunch of money to acquire a company, and and then the people just mass exit out the door.
Yeah.
How do you ensure that doesn't happen?
I mean, that's all about your culture. I mean, that's all about the acquiring company's culture for sure, and how they plan on bringing these things in and proving that they can do M&A. I mean, there's a lot of mistakes that can be made on the buyer side on integration that can do exactly what you're saying, and that'll kill a deal. I mean, the deal will close, it'll happen. The economics on the other side they'll be horrible.
Yeah.
Wrong culture clashes are probably the biggest thing that can kill the integration of a deal and bringing the real value together.
Yeah. What about client capital? So we talked a little bit about making sure you have your contracts in place, but more specifically, what are you looking for as far as mix of revenue? I know you want consistent growth.
Yeah, I mean, you don't want any one client with more than 10% of the revenue. There's no magic number, but for me, once a client has 10% of the revenue, that's like, all right, yellow flag. I got to really think about this. I need to understand that client. Obviously digging into the contract, but there's a lot more questions that are going to go into that particular client. If it starts hitting 20%, I'm discounting the price. There's a price discount at that point. So in many cases tied to that, how did they get that client? Like, what is the relationship? Did it come to a channel partner? Did it come through direct sales? Is the direct sales rep still with the company? Is the channel partner still with the company? Like, a lot of moving parts around that. So in a perfect world, we'd have tons of clients, very little revenue concentration. Churn is huge for me if I'm looking at deals. If the churn, particularly in a recurring revenue-based business, starts getting above 1.5% a month, yellow flag. 2% a month, it absolutely impacts value. So, I mean, there's different levers that I'm going to look at in terms of what the client's profile look like. And then again, depending upon what I'm seeing as we get into diligence, it's going to start working through X turning into Y, right? That's just part of that process.
In the social capital, I already know how you do it. You just told us your secret there. You stalk them forever.
Stalk them. Absolutely, I do.
You talk to the sales rep. So you, even though it sounds like the fluffy one, right? Social capital. It sounds like you do a lot of due diligence in that up front, trying to figure out their reputation in the market, where
absolutely.
the skeletons are buried, all that
fun
stuff.
You know, it's really important too. If you're using your stock as currency versus a cash transaction, that is a whole different sales approach, right? Because ultimately, if you're paying cash, the seller sort of like, look, I don't really care to some degree what you do with this thing long term. I care about my people and my team, but ultimately when you write me this check, like, it's your company. If it's a stock deal, and you're issuing me 20% of the shares in your company, like, I better really believe in what's going on. That is a completely different M&A process than a cash transaction. Night and day, much longer process. And I bring that up because that's where sort of the social capital becomes important. That's where the company's reputation, the industry trade shows, how the sales reps interact, things like that become very important.
Yeah. Interesting stuff. Do all M&A folks invest in all companies? Do you all kind of have your own little niche and investment strategies? Can you explain maybe a little bit how that works?
Yeah, I mean, I think the answer, yeah, there's going to be folks that concentrate on very specific industries, but you're also going to have generalists. So, I mean, I guess let's maybe start with private equity.
Okay.
And think about private equity is the buyer. I mean, a lot of different private equity firms out there. There's, literally hundreds of billions of dollars of private equity right now. That's fresh capital that's sitting on the sidelines, that's looking for transactions. And you've got everything from small market to mid-market up until larger transactions. What I found is, in many cases, there's sort of break points for private equity firms in terms of EBITDA. And what I mean by that is some private equity firms are unwilling to do a transaction that is less than $5 million in EBITDA. For others, it's going to be $10 million. For others, it's going to be $25 million, right? So start talking really big numbers, and you start talking $25 million in annualized EBITDA. They're inside of private equity shops, especially the larger ones. They will have industry expertise. They'll look like generalists in that they may have 100 companies in their portfolio, but make no mistake, they're going to have individual partners that totally understand cloud computing, totally understand data center, totally understand consulting, right, depending upon where it is. And those are the partners that are going to concentrate on working on that transaction. So I think it just, I can't remember the question now, but essentially, I mean, you've got private equity buyers that will have deep expertise, I think, in what they're going to buy. The expertise may not necessarily be in the specific industry, but it might be in manufacturing.
Yeah. So if you're an owner and you're getting ready to engage in M&A, you need to do your research. You need to find that firm that specializes kind of in your market.
Yeah,
your
I mean,
industry,
if you don't have a banker that's going to run the process for you, right, and you're trying to find companies that might want to acquire you, then yeah, absolutely, you're looking at the private equity firms and exactly what they're buying. At least you should.
To piggyback off that, can you explain maybe the difference between investment bankers and M&A, and what are the how are they different? But because I think there's some confusion, and maybe people think they just do the same thing and they're the same
Yeah,
services.
I mean, interchangeable phrases, right? I mean, in terminology. I mean, investment bankers are individuals that are going to help you sell your company, right? You're going to hire them. You're going to engage them. They're going to do a ton of due diligence on your company. They're going to build the offering memorandum, the book. They're going to essentially design the auction, run the auction process, and get you all the way to closing. That's what an investment banker does. They get paid a fee for that. They're not really going to work with you on the front end. They're not the planners. They're not the people to help just get your business set up to sell. That's a totally separate group. I mean, that's what you guys do, right? I mean,
Correct.
It's a lot of front-end work, a year, 18 months before you really want to take your company to market. That front-end work leads into hiring the investment banking group. I would urge any seller to engage a professional advisor to run that process for them. You really want a full auction process. So whether you call them a business broker, a banker, investment banker, practically they all are going to do the same thing, or they should do the same thing, which is take you from putting the book together to closing on the sale. That said, if you don't be surprised if you're approached directly by a private equity firm, right? Mm-hmm. And at that point, like, they're going to try to get you pregnant before you have the opportunity to get the banker in place. Right?
Yeah, because I think about it in the sense of if they can come to you directly before you're on the market, it's a better price.
Right? It's going to be a better price.
To me, an investment banker is the real estate agent. They're the ones that are going to take the beautiful pictures of your home. They're going to write the great descriptions. Right. They're going to drive demand for your product.
I think they're recruiting. Look, it's no different than what you guys do. You guys are a crucial piece of the puzzle, and any business owner that ultimately knows they're going to exit, they have to engage somebody like y'all. at that same point, an investment banker, an advisor has to be engaged to actually run the auction process. If it were me, if I owned a business, that's how I would do it. I would want to have that in place rather than having a private equity group approach me directly. Because at that point, like, I'm probably gonna get an offer, and I haven't had the opportunity to run an auction.
Okay, and I think we might have already discussed this, but just to reiterate again, if I am an owner looking to engage an M&A group, what are some steps they should take? What should they look for in an M&A group?
Yeah, I mean, size for sure. I mean, the size of the firm, where the firm specializes, industry expertise. So different M&A firms, investment banking firms, will have highly likely expertise. If I'm in a specific industry, I want to find that banker that understands what we do and has proven that they can sell companies like mine. And the way I know that is on their website, they're going to have the tombstones, the deals that they've closed, and I'm going to see companies that are in my industry that where they've led the transaction and there's been a closing. I definitely want that experience.
How many deals do you look at? And you can define look at in your own way. Versus how many do you actually execute? So do you look at 100 and execute one? That kind of, what's that ratio?
I mean, so from an investment banking standpoint, I think from an M&A, I can't even remember how many deals I've looked at to close, 20 plus. There's literally no telling how many books came across my desk that I didn't even at that point didn't even engage. Certainly hundreds. Now, from an investor standpoint, for what we do now at Founderville, where we're investing in companies and buying a stake, not buying an entire company. I mean, we've looked at over 100 deals so far, and we've made 8 investments. So,
wow. Is there any difference when you're wearing your investor hat versus your M&A hat? Meaning, would you invest in a company that maybe you wouldn't engage in the M&A side?
I can't. It's hard for me to look at it any different because as an investor, I'm looking at putting money in a company and taking a 10% stake, for example, ultimately knowing that the value creation and the liquidity event's going to come when we sell that company. So I'm looking at it in both ways. It's like I look at it as if I'm a buyer in 5 years, what do I want to see? And that's part of the planning process. But I'm looking at that as an investor too. Yeah. So I wear both hats, I guess.
So you're always starting with that liquidity event in mind.
I have to.
At the front
I have to.
Okay. Shay, thanks for your time. That was really great stuff. How can folks get in touch with you, engage with you? What are you looking for?
Hit me up on LinkedIn, Shay Houser, and Founderville.vc. You can learn about our fund and where we're investing and, types of companies that we like to invest in. Founderville.vc also has information about the Startup Residence Program, where we are out aggressively recruiting software companies to move to Greenville to build their company here with us and folks like you. And we're excited about that. So.
Yeah, and make sure you're out there exit planning and watching your salespeople at trade events.
That's right. Make sure you take care of the sales reps at the trade shows.
Shay, thanks so much for your time. I found great value in your insights, especially this part about how you're already stalking owners to get as much information when they may not even realize it, and why exit planning is so important. But now we want to do something a little special. Marty's been over there listening in, so we want to kind of go to overtime.
Awesome.
Bring Marty's voice in and get some thoughts and questions from Marty.
Hey guys, I've actually been stalking y'all.
Here he is.
Been hanging out, but yeah, Shay, this is your old office, and
I love it.
One of the things I thought about is it's been a lot of money made in this office. So
there's been a lot of deals made in this office. There's been 5 acquisitions. There's been an exit made in this office. So yeah, there's been a lot of investment.
I tell you what, if anybody really wants the money office, this might be it. But
it's a good money office.
It's a great office. But I really love hearing kind of that other side of the story and the challenge. And one of the things I loved your LOI. I'd never thought about that. The letter of non-binding, non-committal.
Non-committal, yes.
Because we could talk a little bit more about the LOI, because I think everybody gets real excited about it, but they don't put enough work into it. Let's talk about it, because I know when we looked at the acquisition, to me, the LOI was a 9-page document. It was the document. Like, to me, that would have been the fighting document, not the let's start the discussion.
Yeah, I mean, I think I'll say this, as a buyer, we would spend a lot of time on that letter of intent. I mean, it would be draft after draft after draft between me and our outside counsel. It's an important document. Mistakes in an LOI can cause a lot of hangover. There could be a big hangover with those mistakes, because if the buyer's reading one thing and then later on you're saying, well, no, it's this, that change causes friction right there, right? So a lot of thought into that. At the same time, is the seller, I mean, making sure you have the appropriate counsel, both tax and legal, going through that letter of intent so that you really understand what it's saying. Dude, that's crucial. Like I am adamant that a seller have the appropriate counsel and the appropriate tax advice early on and fully engaged through the process. It is money well spent.
Yeah.
On the M&A side, is there a strategy to the way you craft your LOIs other than to protect yourselves? But is there an overall strategy of, hey, we want to anchor here to eventually get down to here? Or?
Yes, there definitely is. And it's part of that sort of a gut feel in working with the owner and how skittish the owner might be, how anxious the owner might be, their personal situation, which again, I've hopefully picked up some information during due diligence as much as I can. And what I mean by that is if they're already a little unsure about this and it's I'm still selling, I don't want to send a 9-page letter of intent. It's going to make them nervous. So I might send a 3-page one, knowing full well that we're going to get in some really, meet the sausage making process 30 days later, 45 days later, at which point the deal could fall through because I'm bringing in a lot of other detail that we haven't talked about yet. So there is a strategy to it, but it's honestly a gut feel based on sort of where things are going with the particular seller at the time.
So I think that, what's interesting too is maybe we always said how many deals get done like that you look at. I mean, typically it almost feels like the range is 5 to 10%, if even that. But talk about, really why deals, let's say we get to the LOI, the non-binding letter of non-commitment, but what are the number one, or what do you see as the top reasons why a deal won't go through after you get an LOI? Because people kind of celebrate, they get all excited, we get an LOI, but why would a deal then not go through?
And the number one reason is going to be the financials were wrong, right? I mean, number one, so, I mean, we're going to, we're going to hire an outside accounting firm. They're going to do a quality of earnings. And if the quality earnings report comes back and it's a mess, then that's going to kill the deal. And it's going to kill the deal, not necessarily because we can't get over the hurdles of what was wrong in the QOV. The deal's going to die because I'm going to discount the price by 25% and the seller's going to lose his mind or her mind. Right. So, I mean, that's going to kill it, not necessarily the QOE. The QOE is going to tell me ultimately where I need to price the deal, ultimately where I need to end up on it. So I'd say that's the number one. The number two reason is the seller gets cold feet. I mean, ultimately, for whatever reason, they get cold feet, they get nervous, they have a change of heart, it's too emotional. I can go on for the reasons, but that's it. Those are the two. Every single time, that's what happens.
Yeah. It's actually interesting because I lived that. I think I got to an LOI and I got cold feet, like the numbers didn't work.
Yeah.
And, I think one of the things that as you look at deals, we always said you look at the business, but you also have to look at the personal side, right? The owner's side, that when that deal closes, ultimately, can they live on the number?
Yeah. I mean, that's why tax is so important early on. I mean, it's important for the seller, but as a buyer, I'm contemplating tax for the seller in my own mind. I'm not giving him tax advice, but I know ultimately it's going to impact what the transaction looks like. I mean, for sure.
So one thing you said early on, I think it kind of ties back into this, was doing the math, like pricing the deal. And what I think is interesting is people think that there's really this big complex formula, and there's not, right? It really is two sides of the equation. And based on your business, affects that. Do you want to talk about that a little bit?
Yeah, I mean, I think of it two ways. I mean, private equity is a different animal because private equity is going to use leverage. So they're going to get as much debt as they possibly can, and the cost of the debt impacts the IRR, which impacts the amount of equity they put in, which is going to impact the multiple they're going to pay. I mean, for private equity, it's a little different. If it's a corporate buyer, strategic buyer, where even if it's a stock deal or if it's a cash deal, it's a different way to think about it because they don't have to bring in additional capital. So I think you got to look at it in those two different ways, depending upon whether it's a strategic buyer or a private equity buyer.
But typically, any deal really is it's EBIT, right? EBITDA.
Yeah, it's cash flow.
It's cash flow times a multiplier, and that multiplier based on quality of the earnings, quality of the company.
Yeah, recurring revenue. Yeah. Like how sticky is the revenue? What is the growth rate? What are the synergies that I truly believe I can bring in? I mean, these are all the different things that we're moving around, these levers to figure out, am I paying, 8 times EBITDA or am I paying 14 times EBITDA? And, the range is 6 to 20. I mean, it really is. So private equity, EBITDA is crucial. Strategic, maybe less important because they might be buying it for more strategic reasons. So the cash flow might not be as crucial, but certainly the EBITDA is ultimately where it's going to come down to, and whatever your cash flow is going to be on an adjusted basis.
Yeah. So always a strategic deal, as we've seen, will always give you a higher deal. So if you can find it, 2 then would be a private equity deal. One thing that always comes up, and I don't know if you have any advice on it, but they always talk about when you sell your company, there also is ways that if you're not 100% ready to retire, there are other ways to play this, right? There are other ways they always say maybe a second bite at the apple or whatever. You want to talk about that?
Yeah, I mean, in private equity, again, for sure, in virtually all cases, if you sell to private equity, you're going to get a portion, you're going to have some carry in that deal. Right, you're going to have some stock in the company. So, if you're playing along for the long haul, you're there to get a second bite of the apple for them to sell that company 4 years out, and for you to get a second play. And it depends. I mean, some private equity companies will make you hold. I've heard as much as 40% in stock on the deal. Others, 10% on the low end. I think 20% is a probably pretty standard number. But, I mean, there's plenty of people that have made more money on the second sale holding 20% than they did on the first part selling 80%. Mm-hmm. That's not unusual. That happens. I mean, things got to operate well, clearly. But yeah, I mean, it happens.
Yeah. So I got one last question. I'm kind of curious around, like, in the Founderville that you and Scott have done investing in startups. But has there ever been, I mean, would you take a position in a longer established company? Is that, or is your more thesis is startup, high growth?
Our thesis is early stage. So it's early stage software, tech enabled services, where we expect extremely rapid growth. And what that looks like, if you think about sort of year 2 and 3, we want to see 300% year over year growth. And years sort of 3, 4 to 5, 100 to 200% year over year growth. It is exceptionally fast growth. So that's where we focus.
Well, I think that's about our time for today. Shay, thank you so much for your time and insights. Marty, thank you for the overtime session. Really enjoyed it. And thanks for everybody for listening. And until next time, this is By Design Advisors.